Hi, welcome to the VC Circle Classroom Season 2. My name is Pankaj Dinodia, CEO of Dinodia Capital Advisors. I'll be teaching a class today on valuation in regards to startups. So what exactly is the art of valuing a startup? Well, people will say valuation is a function of both art and science. When it comes to startup valuations, it is more art than science. It is a combination of your gut,
your feel for the business, as well as what really is the market opportunity around the product or the service. If you talk to the most sophisticated venture capital investors in the world, they will tell you it's a combination of their gut feel about the product or service, the management team that is fundamentally driving that business, their own past experience of having invested in a whole bunch of startups and seeing the market overall, and the enthusiasm and the interest that the startup is able to generate in the market. Having said all of that, if you talk to the best investors in the class, Excel partners, the Sequoias, guys who have successfully invested in a lot of startups who have gone on to become the Apples and Googles of the world, they'll tell you that there is some math that can actually happen. There is some science that happens behind the art. And today we'll try and hone down onto what exactly is that science. So just to put a broad sort of spectrum around what are the issues that we're going to discuss today, in my personal opinion, valuation of startups is a function of a few different things. So first is, what is the stage that the business plan is at? Okay, what is it at a drawing board stage? The valuation will typically be lower for companies that are at the drawing board stage. If it's already started generating some revenue, has some customers, it will be slightly higher. If it has positive cash flow, it will be even higher. When we get to the specific section around valuation, according to the heuristics method, we'll dive down further into this section. Next, and very crucially, is the management team. If you talk to anybody who's an investor, they will say it can be any sort of business plan, product, or idea, but fundamentally it comes down to the management team that is sort of driving the business. So what exactly does this mean? From a startup perspective, if somebody's on their first startup, the chances of them getting a very high valuation is difficult unless it's an earth-shattering or disruptive technology with a proven prototype. If somebody's had previous successes, has sold businesses before, chances of them getting a higher valuation, attracting investors is much higher. Similarly, for who that person is, education background, pedigree, previous work experience, all drive down into what the kind of valuation that person can derive. Obviously, if Mark Zuckerberg today decided to start another company, him generating interest or even asking somebody else for money, I don't know why you would do that, would be much higher versus if I was to do a small, little, tiny technology startup. I fundamentally believe there are two kinds of people: guys who can build well, guys or girls who can build well, or people who can sell well. It is very difficult to find these two skill sets in one person. So when venture capitalists look at somebody who they want to invest capital behind, they will try and identify, is the entrepreneur or promoter a builder? Is he good with technology? Can he build stuff? Or is the person very good at selling the stuff that's already built? Ideally, there are multiple co-founders in a business, but not too many. And if they have a combination of somebody who can build well and sell well, those startups will automatically generate higher valuation. Very often in life, you are actually able to find people who can both build well and sell well. That's a golden bet. And very often you'll see venture capitalists backing that individual, irrespective of what the venture is. Because business environments are dynamic. Something that might look great on paper, when it actually gets to execution mode, might be a completely different story. You'll often hear promoters such as Kunal Behel, who built Snapdeal, talk about pivot points of how the business model changes from a coupon book onto an online model onto something different. And it's the dynamic guys who are both able to build and sell who are able to move and change with the changing times. A quick nugget of on startup valuation: always bet on an A+ management team with a B+ plan versus a B+ team with an A+ plan. You'll always get your money out, if not have a bumper success. And then there is a fundamental rule that well-established ecosystems always pay a better valuation versus new startup markets. So for example, valuations in the Silicon Valley in New York are obviously able to generate better kind of valuations than Israel, which is a more nascent stage, versus India, which is even at a much more nascent stage. So that's just a function of the market and then the players, both the demand side and the supply side of that ecosystem. Now to start putting some math behind this art concept. When you talk about valuation, people will often say that the DCF is the holy grail, the discounted cash flow method. It is, anywhere you look across the world, the discounted cash flow is the basic method that is often used for valuing companies. Now, what exactly is the DCF? I won't go into very in detailed description of the method because you're all familiar with it, but it basically projects the future free cash flows of the business and applies a discount rate to bring them back to present value terms, and then has a terminal growth built into the terminal value, which predicts the business after that's reached a maturity stage, and then going forward you apply some multiple to it and discount all of that back to time zero. The reason why the DCF cannot be used for startup valuations is there's a fundamental bet. It's a binary kind of outcome when you're looking at startups. Either it will take off or it won't. The technology will be adopted or it won't. This will fly in the market or it won't. It is very difficult to predict even the revenue line of a startup, let alone the cost structure and the free cash flow that it would generate. So the DCF often becomes very difficult. Certain times the DCF is required just to present to the investment committee or to the board, where you have to size the market, see how big is the opportunity, and then see if the startup will be able to get a certain market share. But again, it becomes very difficult for valuing these startups, because very often the technology is so disruptive that they are creating the product or service for the very first time. So it's difficult to apply the DCF. The next method, which is commonly used for more mature companies, sometimes which are more asset heavy, is the net asset value. What it does is it takes the market value or the book value of all the assets of a company and subtracts the value of all the outside liabilities. What you're left with is the net worth of the company. But for startups, given that they are typically very asset light, you don't have much value on the asset side of the business. And again, it's difficult for startups to raise outside capital in terms of debt, so you don't see liabilities. So unfortunately, the more mature world, which uses the DCF valuation and the NAV to sort of triangulate value, kind of falls apart when it comes to startup valuation. Well then, surprise, surprise, if the DCF doesn't work and the NAV doesn't work, then what works? Let's talk about that next. So when it comes down to valuing a startup, there are 5 methods that are used. The first one is called the heuristics method. I've coined this term. If you open up a book, it's going to be difficult for you to find this. If you Googled it, if you try to talk to somebody, they might cringe a little bit. But I think this is the most commonly used method used by the most sophisticated of investors, which is based, unfortunately, it's based on the gut, but it's also based on their intrinsic experience, having invested a lot of capital in startups all across different sectors. What I mean by heuristics is people have a touch and feel of what they want to invest in a certain startup if they like the business idea and so on and so forth, and what is the minimum stake that they would want to buy into that company. So this concept of pre-money and post-money valuation becomes very important. I had a boss once who had a very simple idea. He said, I want to invest $1 million, and I want to at least own 25% of a company once I've invested the capital. So what that means is it's $1 million divided by 25%, which gives you a valuation of $4 million. The way it works is the pre-money valuation of this business is $3 million plus the size of the investment round gives you the post-money valuation. Two concepts you will always hear investors talk about is this concept of pre-money and post-money, and the cap table. Cap table is nothing but what defines that after the money comes in the company, what is the percentage that this particular venture capitalist, seed fund or angel investor owns in your business. The math is very simple, it's not very complicated. When people throw these jargons at you of pre-money and post-money, now you'll know. Pre-money, your business was worth $3 million, somebody invested $1 million in your business, the post-money became $4 million, the guy now owns 1 divided by 4 or 25% of your business. Very, very simple math there. Very often my boss used to say that if the startup is hot and generates a lot of interest, but the promoter still needs $1 million to get to that next point where they're able to command a much higher valuation, he'll then try to offer a 10% stake. If you take $1 million and you divide it by 10%, it gives the startup a valuation of $10 million. So a lot of the valuation gets driven by not only what the investor thinks about the business, but also from the promoter or entrepreneur side, what is the interest that he's being able to generate in the business. If he's talking to one person and they fundamentally like the business, they can command the valuation that they want. So I'll give you $1 million, I want 25% of your company. However, if you're able to generate interest in your business, that valuation can start looking very attractive from an early stage. Later in the presentation, we'll talk about why it's not very good at the startup stage to get a very high valuation. Here are some other heuristics that people often use. Again, if you look up a book or you talk to people, they might not agree with a lot of this stuff. But if you talk to the most sophisticated investors and see, if you do some analysis around it, this is typically what is largely true for companies in the US. India is still at a very nascent stage, but we will get to a stage where people will start having these sort of benchmarks once they start investing capital in the space. So for a business plan which is exciting and generates some amount of interest, the valuation is typically between $250,000 to $500,000. For somebody who has, and these are all cumulative, so you have to do this plus this plus this to get to this valuation, so just to give them some reference around it. If you have a strong and exciting business plan and you're able to build and develop a strong management team, your valuation gets from that to between $500,000 to about $1 million. If then you're able to have a product that is finalized or a technology that has a prototype, your valuation increases further. It goes from $1 million to $2 million. Then if you're again able to build some strategic alliances, find the right kind of partners, and you started showing some signs of customers coming into your business, your valuation is somewhere between $2 to $5 million. And then if you clearly have a path to revenue growth and scalability of that business, a path to profitability, and are able to generate a lot of investor interest around it, you're able to get a valuation that is more than $5 million. These are all cumulative, as in you need to do this, and this to get to this number. Very often, if you're able to do all of this very early, you'll be able to get a higher valuation. Sometimes, these concepts are so disruptive and nobody's doing it, and it's able to generate some spark in some investor's idea that this business can be scaled up very quickly, and then you end up getting a big valuation for it. But typically, people don't want to overpay for stuff, so they will use some sort of heuristics and gut feel that they've used in the past to give you some valuation around these sort of criteria. The next most commonly used method for all kinds of valuation is the market multiples or the common stock comparison. What this does is it looks at companies that are similar to the company that is currently being valued, how they trade in the market in terms of their enterprise value to sales, in terms of their enterprise value to EBITDA, which is nothing but the earnings before interest, taxes, depreciation and amortization, and the price to earnings ratio. Unfortunately, when it comes to startups, a lot of these ratios are difficult to use simply because of the fact that companies in the startup stage often do not have any positive cash flow or EBITDA and definitely don't have positive earnings. So the only real method that can be used for valuing a startup when it comes to the market multiples analysis is this enterprise value to sales multiple. Now what these multiples are is a function of some balance sheet or market value estimate divided by an income statement estimate. Once you know what is the startup's potential revenue or revenue this year, you can look at what the relative comparable companies in the market trade at on an enterprise value to sales basis. Multiply your own startup sales by that number to get an estimate of what the enterprise value should be. Very often you hear about very interesting metrics around this as well, which is, for example, for Facebook, people used to talk about, what is the enterprise value to eyeballs. Or for technology startups, very often you'll hear what is the enterprise value to the number of clicks or per user. So these are innovative sort of metrics that have been compared across publicly traded companies and the startups that you're trying to value to get at least a sense of it. Otherwise, ideally, you would be valuing a business on all these multiples, on an enterprise value to sales, on a price to earnings, and an EV to EBITDA. The price earnings multiple is the most commonly used multiple worldwide for much more mature companies. All it does is it estimates the growth potential. If the price today is very high and the earnings are low, the multiple is typically higher, meaning that there's a further growth potential built into the business, and then that's the reason why the company trades at such an expensive level. The enterprise value to EBITDA, again, is for more mature companies which have positive EBITDA and are free cash flow focused. It's a very, very common metric used by private equity firms. But for our purposes of this discussion, the most important one still remains the enterprise value to sales, and sometimes the most interesting ones. The next sub-concept I want to talk about is this concept of discount or premium for your startup versus what the publicly traded comparables are trading at. For example, Facebook, when it went public, traded at about 25 times of its sales. If a startup tries to command a valuation of 25 times of its sales, it is difficult to do that. This market multiples method gets governed by several different factors: size of the business, percentage of market share that company holds, the percentage margins that it has, the geographic location of that business. So even if your startup is fairly similar to a company that publicly trades at a very high valuation, it is often difficult, and investors will give you a discount to that valuation simply because you're much more tiny today, you're in a different location, geography, and the business model might be slightly different. If two companies are terribly similar, then you have to think again, is this really an opportunity that you want to go behind if there's a large publicly traded company that already exists? Sometimes companies are able to get a premium. It is those rare companies which are more the exception than the rule. But we have seen companies get a premium to what the publicly traded comparables trade at. The last concept I want to talk about in this section is the LTM, the last 12 months, versus the forward estimates. Given the sheer nature of startup businesses and the fact that they have such low revenue numbers at the infancy stage, it is very difficult to look at LTM or audited figures for these businesses simply because they don't exist. Every investor wants to pay you a multiple of what the audited or LTM number is, and every promoter wants to get a forward estimate. Oh, in 2 years my revenue number is going to be there in 5 years, it will be 100 crores. So they want a multiple based on that. Every investor says, well, let's see what you've done, I'll pay you a multiple of that. Then it comes down to negotiations between the investor and the promoter. And typically you end up getting some either the last 12 months or 1 year forward, or sometimes if you're lucky even 2 years out if the investor fundamentally believes in the business. Next we're going to talk about the precedent transaction, i.e. transactions that have taken place in the past. Every time there is a transaction that happens in the market, it establishes a valuation benchmark. So for example, when you try and value a startup, you look at similar companies and the deals that they've done in the past. Who was the investor? What valuation did they enter at in terms of enterprise value to sales, or if available, enterprise value to EBITDA? And then what can you gather from that transaction? What was the sort of premium built into that transaction? If it's a large publicly listed company, you can see the share price and then what was the premium paid when they entered. If it's another startup and you were able to gather some information around that, what stage were they in terms of their. Why don't we work through an example to make it clear what exactly this precedent transaction multiples are. So for example, a company which has $10 million of sales and was able to get a pre-money valuation of $90 million. A VC invested $10 million for a 10% stake, i.e. the post-money becomes $100 million. Then that implies that the enterprise value to sales multiple for this transaction was 10 times. Depending on the startup, how close it is in terms of this other company that was able to raise capital, you'll be able to either give it a discount and sometimes, very rarely though, a premium to that. 10 times of sales is a very high multiple, but just for the simplicity reason, I use a number like that. The next method used is called the returns-based analysis. It is fundamentally a method commonly used by investors based on their IRR or threshold hurdle rates. What that does is, when analyzing a company, they have fund has certain expectation of how quickly a business will grow, what is the exit multiple that they will be able to generate in that business going forward 3 or 5 years, depending on their holding period, and then what is the IRR that they want to generate from that business. Once you back out the forward-looking estimate of the value and discount it back at the IRR, it gives you an estimate of what is the enterprise value or the market value of this business today. And then comparing it to the sales of the business today, you get an estimate of what that value of the business is to the sales. And then that gives you a multiple, which then investors decide whether it's fair to give that multiple, looking at the other methods of precedent transactions and the market, what it's trading at. The final method that we're going to talk about is the cost to duplicate method. It is not a very commonly used method simply because of the simplicity of this method, and also because of the fact that it doesn't look into the future. All that investors do in this case is they look at how much money or the expenses incurred by the business so far, and what would be the cost to replicate this business if they wanted to do the same. Unfortunately, this is mostly in the cases of where it's difficult to really predict. It's a binary outcome. It's very difficult to predict how the business will scale going into the future. So they just give the value of what is it in terms of the expenses that have been incurred so far. Having spoken about the 5 methods of valuing a startup, it is important to understand that there is no one method that a venture capitalist or an angel investor uses, and neither should the promoters or entrepreneurs should use just one method to try and estimate what is the value of their business. It is a function of combination of all these methods, so therefore there is no one correct way to value a startup. Very often when VCs look at these 4 or 5 different methods, they want to ultimately triangulate to the value where they are not overpaying for a certain business to enter into the business, or they are also not buying a very tiny stake and they'll get diluted if the company was to raise subsequent rounds of capital, which is very often what happens in these businesses. So having spoken about these methods, what does valuation actually matter for? Actually, if the company grows very well, from a startup phase, it goes and ends up becoming $1 billion IPO. Whether you owned 25% of the business or 27% or 30% of it at round 1 won't matter, because it's a super hit and a super success. It's going to be a home run, a super home run for everybody involved in the business. It's the same way if you own 80% or 30% of a company where that went bust, it doesn't matter, because 80% of 0 and 30% of 0 are both zeros. So what does valuation actually matter for? If it doesn't matter in a big case and doesn't matter in the small case, it actually matters when things go somewhere in between, which is what happens to typical investments. What valuation does for these startups, it helps align the incentives between the promoter and entrepreneur as well as the investor. Alignment of interests is the single most important factor that drives the future subsequent valuations and the growth and scalability of the business. The second thing it does is it creates a roadmap and certain kind of targets that the business then can focus on and either grow towards, overachieve or underachieve. and helps the VC or the subsequent round of investor to increase its stake or further dilute its stake, and also decide whether they want to invest further capital in the subsequent rounds. And finally, this concept of dilution is very important. If the promoter or the entrepreneur gets diluted over the subsequent rounds to a very large extent, think about it, would he actually be incentivized, he or she incentivized to come to business every day? So that is what valuation does for a startup. Last section that I want to talk about is some parting advice for both for promoters and young entrepreneurs that are very focused on valuation. Very often we see that people fight tooth and nail about valuation at the startup stage. In all honesty, it doesn't matter. Whether you get a $5 million valuation or a $7 million valuation or a $3 million valuation, it is not going to make a very large difference in the grand scheme of things. Like I said in the previous sections, don't get diluted to a very large extent, and make sure if you're going to raise subsequent rounds of capital, even post that, do some math and see, okay, I don't want to hold less than 40% of this company after I've raised my Series A, B, and C, and then at IPO I at least want to hold X% of the business. What really matters at the starting and inception stage of a business is what is the value add that an investor can bring. So fight for the value add, choose the best investor. Finding the right investor is like getting into a marriage. So choose the partner wisely. See what is the value that they can bring to your business. You are essentially buying a good, by getting an investor in your business, you are getting a good partner and you're buying into their time and mind share. If the venture capitalist or angel investor coming into your business is good, he will help you scale the business, drive the growth, hire the right kind of people, and also most importantly, he will be the person who will then be able to attract other venture capitalists into the business and drive valuation in the further round. So you're splitting the roles. Final word of parting advice is valuation is all a function of scalability. If the business can be scaled and has a good person driving the business, it doesn't matter what the business is, you will be able to derive the value from the good investors. Thank you very much.